Maybe like me, your first bank was a piggy bank. And today we're going to talk about money and banking. We'll talk about types and functions of money. We'll talk about M1 money supply and M2 money supply in a country, the role of banks in an economy, and how banks can create money that doesn't currently exist. So let's get started. When you take a look at these two bills, they'll look fairly similar, but prior to 1958, what you would see is this notice up here at the top that says silver certificate meant that you could exchange your US dollars for silver. We went off of that silver-backed reserve, and now it just says Federal Reserve note at the top of our currency. And that is money that is backed by the good faith of a government, and it's called fiat money. So money has several uses. We can use it as a medium of exchange that allows us to buy, really, and trade anything rather than having to find exactly what the other person would want, or to use the one thing that we make or do, teach, grow corn, etc., and have to trade that for everything else we want or need. And so with money, we can purchase any other item. The person can take that money and then exchange it for the thing that they actually would like to have had. It also is a way of storing value for the future, building up wealth so that we can invest it or use it at a later time, whether that's us as a company, a nation, or a family. It's a unit of account that allows us to compare different goods and understand quickly what the cost or the opportunity costs are between using money one way or another. If I have the option to buy something at $20 or something at $2,000, and the $20 is a meal and the $2,000 is a motorcycle, I can determine, which way to use my money, and if the difference in price for a motorcycle over a meal is worth it. If it's two meals and one's $20 and one's 2,000, and the 2,001 might be because I'm at a fundraiser for a politician, I can decide if that's worth it to me or not. And then standard of deferment of payments is that idea that I can owe you, or someone can owe me later, and I agree that they can pay me over time in the increments of the currency that we're talking about here in the US. That's likely US dollars. And so I might be able to buy a home and move in now and agree to pay a certain amount each month to do that. Money has evolved over time. It used to be that there was a lot of bartering that went on in society. When society is pretty simple and the amount of goods and services is pretty limited, this is a little more easy to manage. When most of us were farmers and there were not a lot of different products that we could choose from, it worked up to a point. Then we moved to commodity money, where we used gold, or salt or jewelry or cigarettes as a way to exchange for lots of other services and goods. As society became even more complicated, we've started printing paper money backed by a commodity, usually gold or silver. So you could exchange the money for a certain amount of gold or a certain amount of silver. Even that's tough to keep around and move between countries. And you don't really want to carry a bunch of gold or silver around. And so we now use fiat money. It's backed really by the trust of the government issuing the currency, and the US has been a very trustworthy world player in this regard, a very stable place with our economy and our political structure. So monetary aggregates, the amount of money in the system, can be classified as M1 or M2. And liquidity is just a fancy financial term to say how easily can we turn something into cash. So the easiest thing to turn into cash is cash. M1 includes cash, coins, even if they're digital. on your phone, in your Venmo, etc., and not really in the bank's hands. They're deposited maybe in the bank in the form of a checking account or through traveler's checks, but they're really money that's sitting there waiting to be spent and is in motion. We're using that money pretty regularly. M2 includes M1 plus all the money that's kind of sitting waiting to be used. It's maybe in a savings or a timed deposit kind of account or a money market fund or a CD, a certificate of deposit. And it's sitting still, not really moving. And that is a very big percentage of the money in existence. But M1 is that that's exchanging hands more readily, and M2 is sitting there and could be put to work, but is more idle in some sort of savings account. If we were to look at a specific time, this is February of 2015, we had about 3 trillion in total M1, and here's how it's broken out. We had about 11, almost 12 trillion in M2. And so that includes the 3 trillion from here and roughly another $9 trillion of money that was sitting in supply. If you were to click here, you can go see up-to-date information. Again, go out, see what's currently true, because we can update with the internet faster than our books can. If you did that, you'd see the M1 money supply in 2019 was about 5.4 trillion, so up significantly from 3 trillion. And the overall M2 money supply with both M1 and the money that's in savings or time deposit accounts would be about $18.5 trillion. And you would be able to see that just by going out. Now, banks, we're probably very familiar with this, but savers deposit money into banks. Those banks turn those into loans to borrowers who pay back the bank the loan amount with some interest. The banks, in turn, will provide savers with money when they want to withdraw it and provide them a certain amount of interest payment back for letting them hold and utilize their funds. As always, if I'm going too fast, please make sure you pause it and look at a particular slide. So a close cousin to banks are savings institutions, credit unions in particular are around more today. You might have seen It's a Wonderful Life, the Christmas movie, and in that, a savings and loans is potentially going out of business. Credit unions are nonprofit institutions. They look similar to banks, but the people who deposit money, the companies that are recognized there with accounts, they're called members. They actually can get a dividend at the end of the year if the credit union makes money. But a credit union is a nonprofit. A bank is a for-profit. In the for-profit, we're just customers who utilize the bank. In a credit union, you're members who are have partial ownership in the nonprofit or a stake in the returns. So these T deposits will always have even amounts on the left and right. And so here what we have is a bank that had 10 million in deposits, and the bank is required by the Federal Reserve to hold 10% of that or more in reserves. And so when the deposits come in at 10 million, initially they're all in reserve at 10 million. But the bank is required, because of that 10% reserve requirement rate, to always keep 1 million of the 10 million deposit in the bank in case someone is coming, members come, customers come and want to withdraw money. But then they can loan out the rest, whatever the percentage that is above the reserve. In this example, it's 90%, and 90% of the 10 million is 9. So you still had 10 million in deposits, 1 million held in reserve, $9 million that's an asset of a loan owned by, in this case, Hank's Auto Supply. Then the bank can have, as they make the loan to Hank's Auto Supply, who then redeposits it in the bank, has to keep 10% of that, or another 900,000 in reserves, but they can loan out another 8.1 million of the $9 million they lent to Hank's Auto. And so you will see that this is called a money multiplier. It's the way the banks kind of, if you will, create money. And if the money multiplier, it's 1 divided whatever the Federal Reserve requirement rate is. It's a little above, I think, 10% right now, but 10% makes for easy math. Then 0.1 or 10% divided into 1 equals 10. So the money multiplier is tenfold. If I put $1 million into the bank can turn that into $10 million using the reserve process that we were just looking at. As they make one loan, keep 10%, loan the other 90%, keep 10%, reloan another 90%, and do that until they've turned 1 million into 10, or in this case down here, 10 million into 100. Most banks are more conservative than that. So they might use a 20 or 30% reserve. If they just went to 20, then the money multiplier, 1 divided by 0.20, the 20%, equals only 5 times as much, 10 million can be used or turned into 50 million by the bank. And to get a better understanding of this, strongly encourage you to watch this little YouTube video. I think that will explain it well enough that you will understand and you'll gain value from watching that. So your exercise for today is to watch this video about Bitcoin, and then maybe you've heard about it. If not, it will be new to you, but it's a digital form of currency not backed by a particular government. And I'm just asking you to think about what you think of this alternative of a fully digital, non-backed by a particular government currency. After watching the video, what do you think is good or bad about it? Do you think it's a better alternative than what we're currently using? Look forward to hearing your thoughts on that. And thanks for tuning in. And we'll connect again for chapter 15 in the near future. Take care. Have a good day.